So we're going to be talking about money management today, and we're going to be talking about this thing also. We're going to be talking about entries. We'll talk about so that we'll round it up on from the start to the sheets. Okay, so most of the live analysis that we give, you can see that you can see that the market actually moving in those directions. So it tells you that price action works very, very well. And what you need to know is to know how to do the money management. And okay, so sharing. Okay, so on our last session of the class, which you can see, pivot point, Fibonacci line, indicators, money management, contents of a trading plan, trading psychology. So is that these are the last parts of the trading. So and it's very, very important at the money management, because when it comes to trading, we are dealing with money here. So when money, anything you are doing as a business and money is involved, decision can change anytime. So there's so many things that can influence your decision also. So that's under psychology of trading. So actually trading, as we can see, is like 80% psychological, then 10% technical, and 10% money management. Okay, so except you have you have enough time to just come master the market movements and then play with the market. Okay, but if you want to trade this market professionally, you need to put all those things in consideration. So these are strategy and principle the Wall Street guys use, the hedge funds use. So you must know that there will be a time of each trade you want to enter. You must consider the amount you are willing to risk at the time. Okay, that's under money management. Then psychology, there will be a time whereby you have a strength of winning. So if you do the psychology of the market, you might by that time you break in transmission. Let me share. Okay, so we're going to be looking at pivot point first. I'll just brush through pivot points. I'll brush through pivot points, and for those who have the second notes, you can as well go into it. Okay. So quickly, pivots is also a form of analysis in the market. Okay. So we have the pivot indicator. You use the pivot point to know the height of the market and the low of the market. Okay, so also pivot is like the middle. Okay, so you pick a height of the market. So you look at the candlestick at the middle of the height of the market and you calculate the high, the lows. So if you calculate the high and the lows, you can be able to deduce your first support, second support, and third support. Then first resistance, second resistance, and third resistance. So a pivot point is a candle or bar which has one candle or bar on each side. Okay, higher or lower than the middle candle or bar. Some trader buy at a pivot low when the price move 1 pips above the height of the middle candle, or bar as the bar pivot is confirmed when price moves above the high of the middle bar. They sell at a point high when the price moves.
Can't hear you well.
Can you hear me? I'm just reading this out. Hello, can you hear me? You know I'm reading. Can you see the notes? Okay, so this is the pivot for this chart now. This is for sell. This is a pivot. So you point out a
I
pivot, and immediately
can see.
this,
I can see.
there's a,
No problem.
there's a movement below the pivot candle. This red candle is now the pivot candle under this. Okay, you sell. That's now is giving us entry. We did this under market reversal, but we are looking at how to use it under entry. Okay, how to use it under entry. So you can use the pivot points, a pivot candle to enter. So this is a place to enter your market. Actually, one piece below it. Then you put your stop loss above the height of the pivot point. Okay, so this is for those of you who don't know what stop loss is. Is a pending order you give to the market. Okay, actually you enter the market, you can give a pending order that if the market go below this certain price, it should close you out in profit or in take or in loss. Okay, so if you want the market to close you in loss, it is called stop loss. And if you want it to close it in profit, it is called take profit. So on your chart, you will see it. Then we have entry. So your entry price is there, your stop loss, your take profits need to be given, but you don't just enter it anyhow. There's psychological level that you need to point out where your stop loss should be and where your take profit should be. So like for this one now, we are using the pivot point. Okay, so this is sell setups. So you look at the middle candle, which is now becoming your pivot point as a sign of entry. Okay, so at the low of this middle candlesticks, what do? You enter. So that's your entry, your price for entry. Then above it, at the above height is your stop loss. So you put your stop loss there. Then your take profit will go to the nearest support level will be your take profit. Okay, so there's a distance between your entry and your stop loss, and then the distance between your entry and your take profit. Okay, so we call that risk to reward ratio, R to R, risk to reward. Okay, this I'm not diving into modern money management now. Okay, so you need to pick a trade whereby you have at least the risk to reward of 1 to 2. Okay, a trade with a risk to reward of 1 to 2. If the setup is not giving you at least you are risking 1 to make 2, you shouldn't be picking such a setup. Okay, because you want to put the edge. If this is a volatile market, and you need to also take advantage of statistics. Okay, so statistics shows that if you have a risk to reward of 1 to 2 and you trade for at least 10 times, then if you can win 5 and lose 5, you still make almost 50%. Okay, because let's say you are risking 1 to make 2. So if you lose 5, it's going to be 1 times 5. That's 5. But if you win 5, which is 2 times 5, that's 10. So we have 10 minus 5, we still make 5. Okay, so that's the logic of you making sure that any trade you are going to get, you are going to you are going to pick a setup that you have a risk to reward of 1 to 2. Okay, you are risking 1 to make 2. That means if your stop loss is going to be, let's say from your entry to your stop loss, it is 50 pips or 20 pips. Let's say for example 20 pips. So if you are risking 20 pips, you are supposed to make 40 pips, so times 2 of it. Okay, so if you are risking 50 pips, you're supposed to have a take profit of 100 pips. So if you can do that consistently and the trade is eating your take profit or your stop loss, there's high chance that after 100 trade, because this is like a probabilistic sample now. After 100 trade, you're going to be in profits. So it's this strategy actually require patience, okay? And you also need to, for those who do not have time to be staying in the front of their system, they can also use this strategy, okay, whereby you get a setup that has a risk to reward of 1 to 2, and you know how much you are going to risk. Okay, so there's a formula I use for money management, which the formula says uh, is a lot size. That's lot size is equals to, because you can use this to calculate the lot size you're supposed to use. So lot size equals to the amount of pips, okay, the amount of pips at risk over the amount you are willing to lose. Okay, so if you divide them, you divide it by 10, you're going to get the lot size that it fits in for your entry, depending on the setup you're seeing. Okay, so we if you can use that to judge, or because you need to predetermine how much you are ready to risk. Let's say you want to risk uh $50 on a trade. Okay, so and you see that the the difference in pips, that from entry to the where your stop loss would be, the difference is let's say the difference is $50, 50 pips. Okay, so if the difference is 50 pips, that means you're going to have $50 divided by 50 pips divided by 10. That will be your loss size. Okay, I hope you get the maths. So the amount you are willing to you are willing to stake in dollars divided by the amount you are willing to risk in pips, then divided by 10. That will give you the loss size you're supposed to use to trade such a trade. Okay, so your this thing, your pips, your stop loss determines the pips you are going to use. Okay, so this one is calculating part of calculations, is the calculations under pivot points, how to get R1, R2, and R3. Is more of story. I won't read that. So if you get your entry, you know your stop loss, then it will be easy for you to calculate your lot size, okay, and also the amount you are going to put in. So it will be easy for you to calculate your lot size, the amount you are going to put in. Okay, this thing, I don't know why it's not loading. Okay, so the Fibonacci retracements, I've explained to us how to use Fibonacci retracements, right? The first points, we've done it, and we've started using Fibonacci retracements. Okay. Technical indicators, we've been talking about technical indicators, and we said uh, some trader don't like some technical indicators because they lag. So we have two types actually. We have the leading indicators and a lagging indicator. I think the oscillator is under the leading indicator, which tells us the bought and oversold and overbought. We discussed that. And then the moving averages are under the lagging indicators. The trend indicators are under the lagging indicators. Okay. Divergence and convergence is another form of trading. We're going to discuss that. Bollinger Band, we discussed Bollinger Band. Okay, so I think this is just explanation on money management. I've just explained it. So money management is all about knowing how much you're going to risk. Okay, so that this is the market. There's nobody that's professional, that doesn't lose in this market. Okay, it's a very risky market. It moves, so it moves every day. It requires a lot to be able to know actually where the market is going. Okay, so if it requires a lot. So you need to also, there are times whereby the market, your strategy is going to be working. Your strategy might not work 100%. There are times that is going to be working very successful. Is going to, you are going to have almost 80 or 90% results. And there are times that the same strategy you are using, and the market is not working according to the strategy, so you'll be losing. So it's good to have a money management in place in such a way that you don't know which of the trade will actually be a good winning trade and which one is going to be a losing trade. So you need to put money management in place such a way in situation whereby you have a losing trade is going to be small loss, and when you have a winning trade is going to be a big win for you. Okay. We discuss all this. I don't want to be. You have discussed all this is on the notes. The risk why you need to put risk to reward of 1 to 2, and if you do the maths, you will always win. Even if you place about 10 trade and you win only 4, if you are risking risk to reward of 1 to 2 at least, you're still going to be in profit. Okay. Psychology. Where is the psychology of trading? Before we go to planning of your trade, and this psychology of trading. Okay, so the psychology of trading, as it is a very very important topic. It's look like it's not necessary, but it's really necessary as a trader. So how do you handle losses? How do you handle winning? Okay, that's what the psychology is all about. How do you handle markets when market is not floating, when market is consolidating, and how to have a mindset, because some people want to be trading every day. There are some times that the market is not suitable for you to trade every day. So you need to be disciplined not to trade that day. Okay. So also the discipline of also using risks. Know when you enter a market, know what is your risk threshold. Okay, so the market is going beyond this level. How can I close it? So it's good for you to plan the trade. So that's why we'll go back to planning of the trade later. It's good for you to plan the trade ahead. Okay, you want to be extremely positive. Why we're discussing this market is Forex is, it can make you, it can break you. So if you don't know how to be able to handle the psychology that will come with it, it will really affect you in the long run. Okay. And also it's good, we can make money, okay, in the market, but it's not a it gets rich quick business like that, as people will just paint it out. You need to work hard, you need to put discipline, you also need to really know that you are dealing with a risk-based business. Okay, so there are times that the market is going to be good, you can make a lot of money very easily, and there's time whereby you can't put, because you make a lot of money very easily, you can't think that the market is very simple, and you start misbehaving, putting different loss sides without understanding what the market is doing. So that they've been patterns psychologically on this market in which if you have a stream of winnings, okay, if you have a streaks of winnings, probably you've been winning, okay, you'll be winning, and if you the it's good for you that after a strings of winning, or after a string of wins, you should just give the market a break. Okay, maybe stop trading for some time and get yourself refreshed and come back and start again. The same thing goes for if you have a streak of losing, maybe you blow an account or you lose and lose and lose. Sometimes you just need to go back again and leave the market for some week or some days, then come back, refresh, and start all over again. Okay. So that, those are the psychology part of it, because when you're coming back refresh. Then if you lose a trade, don't take it personal. Okay, there's sometimes you lose a trade, you say, I've done all my work and why did I lose this thing, you know? So if you're having those emotions of feeling pains and all of those things, you are too attaching yourself to the market. You can't manage funds like that. Okay. And one of the things that will make you not to be able to have this emotional attachment to the market is also knowing to know when to close your markets. That's your exit points. Okay, when the market is going against you, you should know that, okay, this is my risk threshold, I'm closing here. If you are making profits, you know this is my profit, I'm closing here, let me come back refresh. So one thing I observe also about the market is try to be neutral in the market, right? Try to be neutral most of the times. Okay, except you are picking a position actually. So once you pick a position, just try to be neutral also. Because if you say, I've picked this position and it must be this, except and you don't put your money management there, if you don't put your stop loss and you are holding on to a losing trade and you feel you are right, you do not refresh. Maybe there's something, but they use others, you'll be seeing some other analysis that will be telling you that you're right. But the market is not going your direction. So you should know when to close and refresh again. Maybe there's a particular time frame that you didn't analyze well, or you are not trading, you are trading against the impulse of the market, and all those impulse of the market is actually a little bit technical to discover. Probably it is a candle that is from the higher time frame that is retracing, just what we are seeing on volatility 75, or probably a news, just like what happened on, was it on Thursday or Wednesday? You know, the news just came and setups on USD JPY broke out, and some analysis went with the news and some it was against it. So you can't part say what will really affect the market. Anything can affect the market. So you need to be very watchful, or you have to put all these parameters of take profit and stop loss in place. Okay, so as a starter, yeah, as a starter, most of the time you'll be addicted to be seeing the market. You want to be seeing the chart. Is good, okay, but that shouldn't be like you are placing trade on each of the trade, except you've gathered enough knowledge about the markets that you can do such multiple entry. But if you have not gathered enough knowledge about the market, it's advisable to pick one particular pair and monitor the pair. Okay, pick a particular pair, don't dabble into trading so many pairs. Okay, you can, okay, just for variety purpose, you can pick maximums of four. Okay, then if you are trading, maybe probably entry, you should, because most of this market correlates. Okay, they correlate. So if you are trading euro USD and you're also trading you want to trade Euro USD, and you also want to trade Great Britain USD, you want to trade Australia USD, they are all correlated. Both of these trade pairs have USD on them. So anything that affects USD is going to affect all your trades. So it's not really like you are not diversifying. So what I just felt about, if you are about the market, is if you want to diversify, you can diversify into other trading instruments like that are not correlated. Okay, probably like gold. Okay, or silver. And gold is highly volatile. So if you want to trade gold, you also need to know your risk management there also. So you need to know the nature of the pairs. Although they are correlated, but their behavioral pattern are not the same thing. Okay, so it's good to pick like four to study them, then find the one that its behavioral pattern suits you. Okay, so there are some that easily respect the support and the technical part that we talked about. There are some that they respect it probably 50% chance. Some they don't even respect the support and resistance level at all. So you need to understand at least four, just so that you don't complicate the issue if you're a beginner. Then you build confidence on two maximum. So if you want to be more professional, you pick like one and master it. It's not every day you're going to trade. This market is going to be here forever. So sometimes the psychological part, like okay, we want to make money, we want to make money in a rush, can drive anybody to making some radical decision by trading multiple pairs or increasing abnormal loss size and all of that. So you need to understand that is a very risky business. It's sometimes it can be stressful. It's very, very stressful. Okay. It's not as easy as you see at the start. It's just good that okay, some of us we are having mentors. Okay. Yeah, it's good to have mentor that you can ask question, you can relate with. Okay. That will help you. Okay, but it's also a lonely business that you need to be yourself and know what you're doing, and it's the decision should also be yourself. You can ascribe to analysis and also ascribe, but if you really want to know it, internalize the knowledge, you need to also do your own study ahead and know about being patient in the markets and not taking all the opportunity. Just like you are trading, you are seeing a bullish trend, and you are seeing some sell signals on lower time frame. If you are not going to be on your system to watch the move, it's better you leave it and watch out for a buy setups in the direction of the trend. Okay, so that's what the psychology is all about. It's all about knowing yourself, knowing the kind. There are people who can withhold, they can withhold risks in managing risks. Okay, and there's some people where we talked about risks, they freak out. So you need to know yourself and know that the market can twist you. So it's a mental game. Okay, you need to study, know the time session that is best suit for you. So let's just brush through uh let's brush through trading plans for academical purpose, right? So just like the trading part, all what we're saying is about is part of the trading plan. Okay, so trading plan is about good money management. Money management is the most important aspect of trading. As if you fail here, you fail in trading. This is a very personal thing, and only you can write your own plan. A good trading plan should include strategies for profit maximization and loss minimization. Okay, your risk profile, that is how much you are willing to lose on a trade. Just like what I've said, you need to know how much, if depending on how much you have in your account, if it is 10% per trade, if 5% per trade, if 20% per trade, you need to state it out. Hence your stop loss publicly. Risk to reward policy, it is important to establish your maximum exposure. It is accepted that your exposure should never exceed 5 to 10% of risk at a time. Okay, number of trade plan per week. For those who of us who might be working, if you are working and you want to be very, very meticulous about this business, you need to even know how many trade you're going to place in a week. Okay, so that you pick a quality trades. Okay, so um number of trade plan per week, per month, important, so you are not glued in front of your computer 24 hours. A budget, you need to also have a budget, maybe for your light, for your internet connection, for um for even for your trade, how much you are putting as a budget. Okay, so well-defined entry and exit strategy, which we have covered. So I'm going to go more on that, on the entry and exit strategy and why you should enter a certain level. So how you can handle your stop loss and take profit. Okay, so we'll move to the charts. Hello. Okay, so do we have any question on this? So before I move to the next practical session about entry. Hello.
Hello,
Yes.
hello,
Yeah,
hello. Can you hear me?
I can hear you.
Okay. Yeah, quick one. Um, Probably from your experience, how do you handle your own loss? Like when you lose money, because I think everybody lost money in this one.
Yeah. Okay. I see trading as a marathon. It's not a sprint. Okay. It's a marathon and it's not a sprint. And if I lose money, I believe I'm going to make it back in the markets. So I don't kill myself because it depending on the strategy. I just believe that I'm going to make money back in the market. So next time I'm coming, I'm going to be more careful and put in the strategy because there are some time whereby the nature of the market is not just too okay, depending on the strategy you are using at that time. So sometimes I don't really I blame myself. Yeah, we are human, and definitely we are not too perfect. So there will be one time I blame. Okay, maybe I made one or two mistakes that causes that. I also learn from the market, and I know that it's not a sprint; it's a marathon. So if you make a lot, you can make a lot of money today, and tomorrow, if you are not careful, you can lose almost half or everything. So I just have that mindset that this is a part of the business. Losing is part of the business. So I just handle it that way. It was when I started that wow, if you blow an account, it's you have this heartbreak and all of that. So we've gone through that severally. So I just believe that it's part of the business. So I also believe is I'll make the money back. That's how I'll handle losses.
All right, all right.
Yeah.
Thank you.
Okay. Okay. So if you don't have any question regarding money management,
Okay, let me ask one more question.
okay.
Hello?
Yeah, I'm hearing you.
Okay, okay. Here is it. How like how often can someone change a strategy? Let's say you are working with a strategy and it's not working again for a period of time.
Yeah.
Should you stop trading or should you try another trading strategy or what should you do at that point?
You stop trading. If you stop trading, it's not too advisable to be changing strategy. Okay, one of the thing is I observed more is when you stop trading, you come back again. There's high chance that you're going to make profits. Okay, so it's advisable to stop trading for some time, then come back again, than change strategy. Okay, because there are so many strategy out there. Okay, so if your strategy has made money for you, okay, except it has not made money for you. If it has made money for you and you still believe in the strategy, so it's also about your belief, sha. So you still believe, if you still believe on the strategy, it's good for you to just go. If you are me having a streak of losses, just leave the market for some time, then come back again. Just give the market a breathing space and come back again. Then than changing a strategy, except you don't believe in that strategy again. Okay, do you have any question?
All right, thank you.
I have a question, please.
Okay,
About risk management.
yes.
How do we manage our risks?
Okay. It's like you are joining the class. Okay, so let me go back again. This how you manage your risks. Okay. Before you enter a trade, you must know how much you are you are willing to lose on the trade, or how much you are going to risk on the trade. Okay, so let's say for example, uh it depends on how much you want to risk in your trade, but it's better you work with percentage. Okay, so you are advisable to risk between 2 to 10% per trade. So for example, let's say 5%, depending on how much you have in your account. Let's say you have $1,000 in your account, and 5% of $1,000 is $50, I think. Yes, it's $50. So you want to risk $50 on a trade. The trade, if you are the one doing the analysis, you need to know where your take profit is and your stop loss. Okay, where your stop loss is going to be and where your take profit is going to be, and where your entry is going to be, around what price. So for example, let's take this one for example. This is your entry and this is your stop loss, should be above this candlestick. Okay, we are seeing here. So if from here to here is let's say it's 20 pips, or is 50 pips, depending on the range. Okay, so if it is, let's say if it is 50 pips, for easy division, it's 50 pips, and you want to risk 50 pips, you want to risk $50 on that particular trade. So there's one thing you need to determine is the lot size. So in lot size, such a way that once if the market go against you and actually goes almost 50 pips against you, it is only the $50 that you are risking that is going to be taken out of your account. I get me. It's only the $50. So they are now, that you are risking $50 on this based on your stop loss, and your it's based on your stop loss and the lot size you use. There is nothing that will happen in the market. If it goes against you, it's only $50 that it's going to take out, even if you are not in front of the system. So it will close you at a loss of $50. So you need to know the loss size that will make sure that that 50 pips that you are risking is the same thing as $50. Okay. So the
Okay.
formula I say you're going to use is lot size is equals to amount risked in dollars. That means the $50 over amount risked in pips. Okay, which is you are risking $50 and you are risking 50 pips. So if you divide, I think it's going to be 1, right? So you divide it by 10 again. So 1 divided by 10 will give us 0.1, right? So the lot size we're going to use is going to be 0.1. Okay, so I hope you know what lot size is and volume is. Lot size or volume, depending on the chart. So if you use 0.01 and your stop loss is 50 pips, what you are going to lose is $50, because 0.01 means that $1 is equals to 1 pips. Okay, so each move there is 1 pip. So if it has moved 50 pips, it will just take uh $50 out of your account. Now, still under the risk management. Now, as you know your what you are going to what you are risking, you also need to know your what you are willing to gain. That's risk to reward, what you are going to gain. And we said you need to pick a setup that if you are risking 1, you should gain 2. Risk ratio 1 to 2. Okay. So now, for example, this one that you are risking 50 pips as a stop loss, you are supposed to gain 100 pips. So your take profit is automatically 100 pips. Are you getting me? So if your take profit is 100 pips and you set it, if the market go in your direction, it's going to make $100 for you. So if you win, you win $100. If you lose, you lose $50. So that means you have a money management system in place as you enter your trade. But once you put your take profits, you know what your take profit is, you know what your stop loss is, you know what your lot size is. Okay, and that is being determined or that's been determined by the knowledge of the stop loss. Okay, the stop loss pitch. So it will determine your loss size. Once you enter the trade like this, the market will close based on those parameters. Either it's your take profit 100 pips, which is $100, or it's going to hit your stop loss with 50 pips, which is $50. Do you get it? Do you get the explanation? Do you get the money management explanation?
Yeah, thank you.
Okay, so just know the numbers, know how much you're going. That's what the money management is all about. It's about knowing how much you want to risk on a trade and do the calculation, knowing the amount of loss size you're supposed to use. And once you know the loss size, it's explained here, but maybe in different format depending on the accounts you're going to use. But the simple way is knowing the loss size, which loss size is equals to amount in okay, so let's pick entry. I think we'll do just a little explanation. Okay, so we're having this chart. Okay, so now, for example, on this chart, now we have. Let me just change this color.
Shit.
Okay, so for example, looking fetching for entries on this. These are Australian GPY, right? It was undergo a bearish move. Just underwent a bearish move and touching the support around this place. So let's say for example, you want to trade this retracement, right? This is a retracement going on. Probably the market might retrace back into the middle of this place. We just that it will retrace to this place. So, for example, now you have this chart and you want to enter your trade. This actually based on retracement because the major trend is still bearish. Or based on retracement, it might just trade up, start selling again. Now, if you do all your technical analysis, and in fact, you carry out analysis technically and draw your trend line, support and resistance level. So you have this market. Based on this market, you want to pick if it is buy entry, you want to pick. Okay, it's advisable you see the market open and close at the trend line. Okay, then you have to wait because wait for a retest. Okay, if you retake this trend line, this I'm teaching you how to get fresh entries now. So when once you pick the trend line, you're going to pick your entries, making sure you touch this one. So you pick your entries around somewhere here. Okay, so you pick your entry somewhere after the retest and it's going up, you pick it around somewhere. So your stop loss, where will your stop loss be? You need to give room for the market. Okay, so you put your stop loss somewhere around here or at the supports or at the previous supports here. Okay, so let's say you put it at the previous support here, you calculate the distance from here. So from here to here, you can see easily is around 43 pips. Okay, so automatically you are risking how much now? 43 pips as your stop loss. So if you are having a 43 per stop loss, you need to weigh your take profits. So your take profit is supposed to be 86, right? So you see, it should be around 86 pips. So your take profit is supposed to be around this place. Okay, that's 86, 86. Okay, so you do your calculation depending. Let's say, for example, you want to raise $50 on this particular trade, and your stop loss is 43. So what you need to do is you're going to say $50 divided by, or 50, which is in dollar, divided by 43. Okay, so 50 divided by 43, and so you divide 40 by 40, 43. 50 by 43. Let me get to do this thing. Okay. So you're going to get 1.116. So you divide that by 10 again. So you're going to get 0.01. So that will be your loss size. So if you want to enter the trade now, okay, you you pick this, your stop loss. Okay, your entry now is going to be your loss size, which is the volume now. You've calculated it already because you are risking $50. So you put that 0.11. Then you put the stop loss. Okay, the figure of the stop loss there. Okay, so I think is I'm not saying it very wrong. So you put this number here in this box, then you put this one up on your take profit, then you click on buy. So immediately you click on buy, you've already entered this market with a predetermined exit. Okay, so once the market hits this place, it will take you out in profit. If you hit this place, it take you out in loss. That's stop loss. So probably you can now reevaluate again that probably this market is not ready for turning up. It wants to continue the bearish movement. So you look for a sell entry. Okay, so but actually you remember the rule that you're supposed to pick an entry in the direction of the impulse. So if you go to half time frame, you can see that actually there's a lot of bearish pressure in the market. It's just that it is very, very close to a support level, but we still have a seller in this market, so we don't know whether it will be able to break this support level. Okay, so but you know that for a market to change the trend, it has to break the trend. So if you're looking at this trend until it break the trend, that's when you're supposed to get an entry. So we did our calculation based on the break of the trend actually. So if this goes up and break the trend and retests, then you enter and put your money management in place. Okay, so do we get it? Do we get the calculations on under this money management?
Yeah.
Yeah.
No.
Yeah, you
So
get the calculation right. So just write the formula. The loss size will determine how much you are going to risk. You are going to close the trade at eventually. Okay. So entries is very, very important. So entry is very important. The time frame I use actually to get entry is 1 hour and 30 minutes. Okay, so we use the 4 hours and daily for analysis. But if you want to get your entry, you use 30 minutes probably. Don't go below, except you want to scam. Don't go below 30 minutes because this is a very low is low time frame, and low time frame you can get several entries, you can get several setups, but on at least 30 minutes and 40 and 1 hour is a very clinical entry for your analysis that you've done on 4 hours and daily time frame. Okay, let's check. Let's see, we have this market. Remember we were talking about Great Britain JPY, if it will fall or not. It has finally fallen and it is bearish. So who can tell me what's happening in this JPY? Great Britain JPY, who can tell me what is currently happening on the price? Okay, so just trying to see. Now we can see that the market is pulling back into the cloud of the Ichimoku. Okay, and you can see that there was a flush down yesterday, and today the market really fell heavily. So we might just observe that the edge of the Ichimoku can stand, of the clouds of this Ichimoku, that can stand as what? As a support level. And technically from the candlestick, you can see it previously. We have this level here. We have another level here. And, because it's touching the cloud, you can have another level here. Okay. So you can see that this market can just have a huge pullback. Okay, because of the ball. Some people, if they don't understand the psychological level and you just see a candle falling like that, you don't know when the trend has started and when it has ended. So you might get a setup, but how far is the setup close to the next support or resistance? This is what you need to find out before you enter the market. It's also part of the money management also. Okay. And then when we talk about money management, we also talked about how to reduce your exposure. Let's say you enter a trade with one standard loss size and you made a profit and you are not sure whether the market can still go further ahead of you. You can have closed the trade. Okay, you can close 0.05, or you can close you can close 0.5 loss size. That's half of the standard loss size. Okay, then you can also move your trade. We call it trailing. You trail the market. Okay, that means you can move your stop loss. Okay, let's say you enter the market at this place. Your stop loss was somewhere here, and you enter here, and the market has already moved in profit, but because you want to ride the move, you can quickly move your stop loss by modifying or adjusting. You pick the stop loss from somewhere from above the entry to below the entry, so you can lock it here. Okay, so this is your entry. You're already in profit here. The price is still moving below. You can decide to, so we have what we call moving the stop loss below the entry or above the entry, or moving it into break even. Because there are some time whereby you have a winning trade, and if you don't manage the trade very well, the winning trade can turn to a losing trade. So in order to avoid a losing trade becoming a winning trade, I mean, becoming a losing trade, you can reduce the loss. You can, close part of the trade, and also move your stop loss. So you can move your stop loss to break even or to take profit zone. So probably the market starts turning back and maybe turn back to this resistance level, and it was not resisted, it broke it and it was going up, it can close you still in profit rather than leaving it till it goes back into the entry point and become a negative trade. You already reduce the loss size by closing part of the profit. Also, you've moved your stop loss below your entry. Okay, so now you're already in profit. You've locked the profits. Okay, so those are other strategy or other things that you need to consider under money management. So it's all about, make don't leave the money on the table. Okay, so even if it's small profits and you are not sure about the trade, it's good for you to close it though. But one of the perfect thing about uh, using money management is also having the discipline of waiting for the market to either hit your take profit or stop loss. So micromanaging markets has its own advantage and disadvantage. Okay, you are micromanaging the account. You actually put your own take profit and stop loss, but still you want to be shifting the stop profit and take profit. So if you don't have experience and you are doing those shifting, it might be probably just a small retracement and you shift it and then you close and you want to enter in opposite direction. Before you know, the market will turn back again because you don't really know the impulse of the market. It's just you are looking at the profit margin. If it's green, it's in your favor. If it's so, sometimes the market can be red against you. It's just finding a breathing room. Okay, so it will go against you within a short period of range, then later come back and go in your favor with a huge profit. So if you don't have patience to wait for all those things, you will always be closing small profits and allowing big loss to run, which is not good for the account. For the principle that will work in the account is always allow your winning to run and close your losing. Don't allow losing trade to take over the market, take over your accounts. Okay, so when you know how to do those things is fetching entries. You don't trade with impulse. Okay, you must be disciplined and tell the market to do A. If it has done A, you can now go into the B. Okay, why? What did I mean by that? Now, for example, we said this one has dropped rigorously, and we said it is at support, right? So you need to wait that actually, excuse me, the support is going to hold. So you don't just jump and enter and say, okay, because it's eating a support, let me enter buy. No, you need to wait and be patient. This 4 hour chart to see a reversal candle. Okay, a reversal candle forming at this level, and at the same time you see another candle that forms and confirm the reversal candle that is forming now. If another big candle forms here and confirm it, and then you see a bullish market going up, that's when you're supposed to enter. Okay, so if you jump and enter a support and the support is not too strong, okay, and the market breaks it, it will end up losing. Or when you enter now and then the market just push into the nearest moving averages, okay, just like what happened here, you enter into the nearest moving average and it will not continue again. Okay, so it means that the bearish trend is still persistent. So one of the thing also you need to do is to draw your trend line. Okay, so if you draw your trend line and you can walk back when the trend line is broken. So for someone to enter here because of this small buy and you enter, mainly it hits the trend line, so it's pushed down. So there might be also buy. If this buy did not break this trend line, it means that the market can still go down again. Okay, so clinical entry like this on lower time frame. Okay, you can see something like this on higher time frame and you can buy from year to year. It will be a big move. Okay, if this is daily, something like it, definitely there's this. But this is 30 minutes. So it means that you don't need to enter the buy that is forming here. Just wait for the trend to break if you are going to buy, or just allow the market to the touch the trend or the moving average, and if it's ready to go down again, you can follow it down. Okay, so this is how to fetch entry from the lower time frame. Okay, this is where to you do your analysis, come to the lower time frame. You need to know, okay, if there's a trend break, you wait for the trend to break. If there's support formation, you also need to wait for the support formation before you enter the market. You don't trade impulsively. Okay, because you are seeing a bearish candlestick, you just enter the market with a bearish candlestick. No, you need to know, where is the bearish candlestick forming? Is it close to the market? Okay, now if you observe this trend very well, you can see that it's more of breathe out, breathe in, breathe out, breathe. This is like the rhythm of the market. So you need to know the rhythm of the market if you want to fetch your entry. Okay, so if you, as you draw your trend line, or if you use the moving average to observe this, you can see that this market is perfectly trending down. So it's advisable to, if you want to enter a sell, don't enter a sell at this level. If once the market is very far away from the moving average, or from the trend, or from the a cloud, and you know the direction of the market, don't enter yet. Just allow the market to come close, to pull back into the moving averages or pull back into the trend